The screen is red. Every chart is falling. Your phone won't stop buzzing. And somewhere in the world, someone just sold everything at the worst possible moment. Here's the uncomfortable truth most people never hear. Stock market crashes don't destroy wealth. Panic does. In fact, almost all long-term money in the stock market is made because of crashes, not in spite of them. But when a crash actually happens, logic disappears. And that's exactly when the system makes its move. Let's talk about what's really going on and what smart investors quietly do while everyone else is panicking. Every crash feels like the end of the world. 2008 felt like capitalism was collapsing. 2020 felt like the world itself was shutting down. 2022 felt like markets would never recover. And yet, zoom out. The S&P 500 has crashed more than 30% multiple times in history. It has dropped 50% before. It has dropped more than that if you go far enough back. But over decades, the same chart keeps doing one thing: up. Not smoothly, not politely, but relentlessly. Here's why that matters right now. When markets crash, prices fall faster than reality changes. Companies don't suddenly forget how to make money overnight. Factories don't disappear. Customers don't vanish forever. What does change instantly is sentiment. Fear spreads faster than facts. And the stock market, in the short term, is not a machine, it's a crowd. So what actually causes a crash? Usually not one thing, it's a chain reaction. Interest rates rise, debt becomes expensive, profits slow, big investors rebalance, algorithms amplify selling, media headlines pour gasoline on the fire. At some point, selling stops being rational. People aren't asking, what is this company worth? They're asking, how fast can I get out? That's the moment most retail investors make their biggest mistake. They sell after the damage is done. Look at the math. If a stock falls 50%, it doesn't need a 50% gain to recover. It needs 100%. Selling after a crash locks in the loss. Staying invested gives recovery a chance. But here's the part no one likes to admit. Knowing this doesn't make it emotionally easy. Let's talk about what smart investors don't do. They don't try to predict the bottom, because no one can. They don't believe headlines that say this time is different. That phrase shows up in every crash, and it's almost always wrong. They don't watch their portfolio every 5 minutes, because staring at losses doesn't improve decision-making. And they definitely don't move everything to cash out of fear. Why? Because the market's biggest gains often happen during the most terrifying periods. Miss just the top 10 best days in the market over 20 years, and your returns get cut in half. And those best days, they usually appear right after the worst days. You don't see them coming. So what should you do during a crash? First, slow down. Crashes create urgency. Urgency kills strategy. Before touching anything, ask one boring but powerful question. Has the long-term story changed? Not the price, the business. If you believed in a company, index fund, or strategy before the crash, and nothing fundamental is broken, the crash didn't make it worse, it made it cheaper. Second, understand where you actually are in the cycle. If you're investing for retirement 10, 20, 30 years away, short-term crashes are noise, painful noise, but noise. If you need the money soon, the mistake happened earlier, not during the crash. Crashes don't punish investors, they expose mismatches between goals and risk. Now here's where smart investors quietly gain an edge. They rebalance. When stocks fall, their portfolio becomes unbalanced. Stocks shrink. Cash or bonds grow as a percentage. Rebalancing means selling what held up better and buying what fell. It feels wrong. It feels uncomfortable. That's why it works, because you're buying assets when fear has pushed prices down, not when confidence has already returned. This isn't bravery, it's discipline. What about buying the dip? This phrase gets abused. Buying blindly during every drop is not strategy. It's gambling with better branding. Smart investors buy gradually. They average in. They spread purchases over time. They assume prices could fall further and plan for it. They don't ask, is this the bottom? They ask, is this cheaper than before, and does it fit my plan? Very different mindset. Let's address the biggest myth. The market is manipulated. Retail investors always lose. Here's the nuance. Yes, markets favor patience, scale, and emotional control. And no, that doesn't mean they're unwinnable. The market doesn't care about you personally. It doesn't hunt individuals. It rewards behavior. If you panic, overtrade, chase trends, and react emotionally, you lose. If you stay invested, diversify, rebalance, and let time work, you win. Not instantly, not dramatically, but consistently. Crashes feel unfair because they are indiscriminate. Good companies fall with bad ones. Smart investors feel the same fear as unprepared ones. The difference is what happens next. Most people want certainty before acting, but certainty only returns after prices recover. By then, the opportunity is gone. This is the cruel irony of markets. The moment things feel safest is usually the worst time to buy. The moment things feel unbearable is often the best. So here's the real strategy during a crash. Not predictions, not bold moves, not panic. A written plan you made before fear arrived. Diversification you didn't abandon. Time you're willing to give the market. And the humility to accept that discomfort is the price of long-term returns. Because if investing felt safe all the time, everyone would be rich. The market doesn't reward intelligence alone. It rewards endurance. And that leaves one final question hanging in the air. When the next crash comes, and it will you react like the crowd or like someone who understands how the game is actually played?